So suppose you manage an 80-20 portfolio. That means 80% equities and 20% bonds. And let's say that this total together is $300 million. It's a $300 million portfolio. Given these ratios then, that means that your money is invested $240 million in equities and the remaining $60 million in bonds. But suppose that you wanted to change your asset allocation mix. That is, you had this portfolio that was 80-20, but you wanted to change it such that you decreased the amount of equity exposure and increased the amount of bond exposure from 80% equities to 50% and from 20% bonds to 50% bonds. This is your target allocation. It's the number that you want to get to. And we could just take our existing portfolio and sell a bunch of equities and buy a bunch of bonds. But given this portfolio size and the degree to which we want to alter our portfolio, that could be very expensive. We'd incur a lot of transaction costs. And if this wasn't a long-term decision, maybe we just wanted to reduce our equity exposure because we thought we were headed into a temporary downturn, and so we wanted to reduce equities and strengthen bonds. But we didn't want to keep this target allocation forever. It was just, say, for the next 6 months. All the more expensive because we would have to sell off these positions to get to this target portfolio, but only do that for 6 months, and then 6 months later, go back and buy equities and sell off our bonds. So with these types of temporary deviations in particular, to a temporary target allocation, we incur a lot of commissions, transaction costs. And so one way to avoid all that is to use futures contracts. We'll effectively get the target allocation that we want, but at a much lower cost. Here, what we want is to decrease temporarily our exposure to equities. And going from 20% to 50%, we want to increase our exposure to bonds. When it comes to futures contracts, the way that we do these two things is that to decrease exposure to something, particularly a long position that we hold, we will short that thing. And when we short in a futures contract, that means we sell the futures. And likewise, if we want to increase our exposure to the underlying bonds, we have 60 million, but we want more exposure to bonds, we can buy bond futures. And we can just generally visualize conceptually how this would look if this is our underlying portfolio and equities go up. If we wanted to increase or decrease our exposure to equities, what this means is that we're making our equity portfolio less sensitive to equity movements. And so if we find this offsetting futures position that goes down when equities go up, goes up when equities go down, and vice versa, we can get a portfolio that looks flatter, less subject to equity movements. It's the same hedging strategy or the idea behind hedging that we've looked at previously. In this case, what we're doing is decreasing how sensitive our $240 million equity position is to the overall equity market. Effectively, that gets us an equity position that may be similar to, say, 200 million. Actually, in this case, it's going to be 150 million if we're assuming that half of our equity position is invested in, and the other half invested in bonds. And this is different than the hedging ideas that we've looked at before. If we wanted to increase our exposure to bonds, if we wanted effectively a $150 million bond portfolio, almost twice, more than twice, the existing allocation to bonds that we currently have, what we would want to do is not short bonds. We don't want to decrease our exposure to bond market movements. We actually want to increase our exposure. And the way we can do that cheaply is just to buy more bond futures. Having a bond, a bunch of bonds plus a bunch of bond futures gets us a overall portfolio that is much more reactive to bond market movements. In effect, getting us to a larger bond portfolio. So putting some numbers on all of this, if our target allocation, what we want to get to, is a 50-50 mix of equities and bonds, and we're still managing a $300 million portfolio, it's just that we're adjusting the mix of equities versus bonds, then these are the dollar amounts that we want to invest in stocks and bonds, respectively. 150 million in each. And so we need to get from 240 million and 60 million to 150 million and 150 million. We need to get from here to here. And the difference between these two is sort of like the amount that we need to trade in terms of futures to trade to get to our target asset allocation. That means we have $90 million of equity exposure that we need to deal with in order to get to that 50-50 split. And as it happens, also $90 million of bond exposure that we need to deal with through futures contracts. And because we wanted to, or we needed to sell equity futures to reduce our effective equity position, that means we need to decrease our exposure by 90 million. And because we wanted to increase our bond exposure so that we have a higher effective allocation towards bonds, we need to purchase an additional 90 million of futures exposure when it comes to bonds. The only question then is how many futures contracts it's going to take to get to that. Let's start with calculating the equity futures position, how many equities we need to sell first off. And to do that, we can use this formula. The number of stock futures, equity futures, that we need to buy or sell. In this case, we know that we need to sell because we're decreasing our equity exposure, is equal to the number, well, the dollar amount of stock exposure that we want to get. In this case, we want to sell or reduce $90 million worth of equity exposure divided by the futures contract size. And when we say the futures contract size, we include the notional amount. So it's like the price of the futures contract multiplied by the multiplier for just one futures contract. So in other words, it's that big number. In this case, one futures contract, just one contract, the notional amount for an equity futures position, let's say on the S&P 500, is going to be $200,000. And we're close, but not quite there yet. I mean, at this point, we know that we need to reduce exposure, so we know this is going to be negative, by 90 million, and it's going to take 90 million divided by the size of each futures contract to figure out how many futures we should actually buy to do that. But the one thing that we also need to look at is the relative betas of the futures contract versus our underlying equity portfolio. Because betas measure how sensitive something is to the overall market. And if our futures position is more sensitive to the equity market than our underlying portfolio, or vice versa, then we actually haven't really decreased our equity exposure by the right amount. And so we have to scale, in this term here, whatever amount of futures that we're going to purchase or sell by the relative betas of these two contracts or positions. And so it's a formula that we've seen before. On the numerator, it's the beta of the target portfolio that we want to get to minus the beta of our portfolio itself, but divided by the beta of whatever equity futures contract we're buying. Except in this case, what we're really trying to do is reduce $90 million of exposure, of equity exposure. And so you could say our target beta here doesn't exist. Like, more precisely, the target beta is 0. We're trying to get this $90 million down to 0 market exposure, 0 equity exposure. And so what's left is just the ratio of the beta of our portfolio to the beta of the futures contract. So we'll need to find out the two betas. The portfolio you can take as given for the moment, and the beta of the futures contract is something that you can typically find out on a financial aggregator site, a financial news site. Taking the beta as given here, let's say the beta on our underlying portfolio is 1.1, and the beta on this futures contract, let's just say it's 0.096. So the futures contract is less risky than our underlying portfolio as a whole. And if you notice, when you take this number and divide it by the other, you'll get a number that is greater than 1. And that means that if this is like a scaling factor, all that stuff that's in this parentheses here, then if this is otherwise the number of futures contracts that we need to buy, saying that because this futures contract is less risky than our underlying portfolio, we need to scale that number up, the number of futures contracts that we need to buy, in order to effectively eliminate the equity risk of this overall position. We need to buy more futures, in other words, than we otherwise would, because the futures contract is less risky than our underlying portfolio. So plugging these numbers in means that this term becomes this, which is in turn simplified to this number here, and then simplifying further, we get a number for the amount of stock futures that we need to sell of 515.63. And so we can't buy 0.63 of a contract. We'll have to just get as close as we can get. So it won't be a perfect hedge, but it'll be pretty close. We'll sell 515 equity futures. And so we're almost there. We figured out how many equity futures we need to sell. The next step, or the final step, is how many bond futures we need to buy. Because if we're going from an 80-20 to a 50-50, that means we're selling equity futures, reducing our equity exposure, but increasing, going from 20 to 50, our bond exposure. So we need to buy bond futures. But the question is, how much? Because if you recall, with bonds, we don't have betas per se. We have futures on bonds, but what really drives bond prices and bond price futures is the bond's duration, not their beta. And so when we want to find how many bond futures to buy to increase our bond exposure effectively, we still have to look at how much we need to increase our bond exposure by. This amount here, 90 million, is how much additional exposure we need to get. And like the equity example, we still need to compare that amount to trade to the contract size for the underlying futures, in this case bond futures. But we then need to scale that not by an equity beta difference, but a difference instead of the modified duration of the two different portfolios, or the modified duration of the underlying portfolio versus the modified duration of the futures position. So our formula, our general formula, looks something like this. It's the amount of bond exposure on a dollar basis we're trying to increase or decrease, in this case increase, divided by the individual size, dollar size of a single futures bond position, but scaled by the difference between the modified duration of a target portfolio and the modified duration of our existing portfolio, divided by the modified duration of the futures contract itself. And let's see if we can take this general formula and insert some numbers that we have. B, the amount to change the allocation by, or 90 million, and F sub B, the size of an individual futures contract, which in this case, let's say it's 105,250 per contract. And then the modified duration of our underlying bond portfolio and our futures portfolio, respectively. And let's say those numbers are 6.5 and 6.85. So we have all the numbers that we need to plug in. And if we do that to figure out the number of bond futures to buy, we have 6.5 in the numerator and 6.85 in the denominator, the two modified durations of the bond and futures positions, respectively. And notice that we have the modified duration of the target portfolio. That's like what we had in the equity example here. What that means is that effectively this is zero. We're trying to completely eliminate any bond risk for this not completely eliminate any bond risk. What we're actually trying to do is increase our bond risk. So this works if we're trying to hedge out or sell bond futures. But in this case, we're trying to actually buy bond futures. So what we need to do instead is look at it like this. The duration of this, the modified duration of this bond portfolio, think of it as we're starting from zero. We're trying to scale up our bond exposure to a specific target amount. And so it's like we're trying to get, not that we have 6.5, that's almost actually just what we want to achieve. The modified duration of the target portfolio is that 6.5. We want to get to that point. And we're starting from a point of zero. We're trying to increase our bond exposure. And that gives us the number that we need without having to kind of change the formula. That is, we have a positive sign here, meaning that we're buying bonds. And specifically, we need $90 million of those bonds to get us to that 50% asset allocation mix. And each bond futures contract is worth $105,250. So, simplifying these two terms here tells us that the number of bond futures that we need to buy is 771.97. That's pretty close to 772. So let's just call it 772. All right, so let's just bring this all back together. We are shifting our asset allocation with futures. And in particular, we're decreasing our equity exposure, increasing our bonds. This is our example here we had this $300 million portfolio, and if we wanted to get to from an 80-20 mix down to a 50-50 mix in terms of our asset allocation, we just figured out how many how many equity futures we should short and how many bond futures we should long. Using those formulas that we saw that we should sell 515 equity futures and buy 772 bond futures. And if we do that, that'll get us from a 80-20 portfolio to effectively a 50-50 portfolio. We didn't actually change our underlying portfolio here. What we did was overlay a futures position, these two sets of contracts below, to effectively get us there. If you consider the futures and underlying position combined, we've now effectively got a 50-50 portfolio. And so the last step is just to verify that. That is to take an example of what happens to our total position, underlying portfolio and futures combined, when the equity and bond markets subsequently change. So with our underlying portfolio, we have $240 million in equities, $60 million in bonds. That's our underlying portfolio. And that hasn't changed throughout all of this. We have this, plus we have futures. We'll have some profit or loss on the futures positions that we took. So let's say that the underlying portfolio, that equities and bonds, that equities subsequently fell by, say, 3%. And bonds, they rose a little bit to 1.25%. This means that after these market movements, your portfolio, your equity portfolio has dropped, while your bond portfolio has risen slightly. And on net, the portfolio as a whole has dropped a little, by about $6.5 million. And just to keep things clean, I'm going to bring this to a new page here. Let's compare this $293 million to a hypothetical portfolio. That is, suppose that we hadn't done any futures at all, and instead, to get to our desired 50-50 asset allocation mix between stocks and bonds, we just straight up sold stocks and bought bonds at our desired target level. So 50% stocks in a $150 million portfolio means we sold such that we ended up with $150 million of shares and bought bonds so that we had from a $60 million bond portfolio to a $150 million one. And under the same scenario then, if subsequently stocks fell by 3% and bonds rose by 1.25%, then the value of these two positions together now equals a loss of about $2.75 million, but not as big of a loss because we had reduced our equity exposure, and equities are the most that dropped. But maybe our expectation of falling equities is why we wanted this 50-50 asset allocation in the first place. the point is whether we do this using actually trading in the stocks and bonds, or we use futures to synthetically construct that effect, but at lower cost. And if you recall, we went through this exercise of calculating precisely how many futures we would need in order to do that. Let's see if that would actually work, if this synthetic construction would actually get us the same effect as if we had bought and sold the underlying to reach this hypothetical portfolio. So we had figured out that theoretically we needed to sell 515 equity futures, and that each futures position had cost $200,000. If this is what we sold the futures price at, and we sold 515 of them, then if the market subsequently dropped, the equity market dropped by 3%, and so our futures position dropped by 3%, that means the 200,000 dropped to 193,600. And so this is a negative number because we were shorting, and that means that profit on this short equity futures position, when the market falls by 3%, is a dollar profit of about 3.3 million. And that's for one side of our derivatives position. The other side is that we bought bond futures. We had bought 772 of them. That's how much we needed, we figured, to get us to the desired 50-50 portfolio based on the size of our portfolio and the duration of the futures, the bond futures contract, and the duration of our target portfolio. Each bond futures contract was worth $105,250. So that's what we bought at, $105,250. And the bond market actually rose, rising by 1.25%. And so that means our $105,000 position jumped up to $106,691. And we had been long because we wanted to increase our bond exposure. And in that case, it worked out for us because bonds rose. And we made a net profit on just the bonds of about $1 million. And if we combine the profit on these two positions together, we see a total profit of $4.4 million on just the futures positions. And the way that we did this strategy is that we kept our original portfolio, but we added on these two futures trades as a sort of way to synthetically change our asset allocation mix. And if we consider those two together, the value of our underlying portfolio plus the change value of our futures position, the net amount is a value overall of $297 million. And look at how that compares to the value that we would have received with our hypothetical portfolio if we had just sold the stocks to get to 150 million and bought enough bonds to get to 150 million. If we had manually changed our asset allocation instead of using futures to get there. The two numbers are very close together. The difference being basically because of rounding on that futures contract on both of these futures. But the two are very close. And so at a lower cost, we've used futures positions to effectively go from an 80-20 portfolio to a 50-50 portfolio. That's kind of the magic of how this buying and selling works and how these formulas work.